Hey, this is Chris Trapani, the Mortgage Pro. You know, people ask me all the time, whether they're realtors or the consumer, they ask me all about a CalHFA loan. Zero down payment. Do those programs really work? Do they exist? Absolutely. And today, I'm going to teach you about the good, the bad, and the ugly. All right, a lot of people want to buy a house. They don't want to put a down payment, or maybe they just don't have the down payment. The CalHFA program is going to lend you, they're not giving you, they are lending you the money for a down payment. Now, as an example, on a $300,000 purchase, on an FHA loan, you would need a $10,500 down payment. What happens is we have a program tied to CalHFA called My Home. And My Home is actually going to give you a loan for $10,500 for the entire down payment. Fantastic, right? Now that loan is called a silent second mortgage. You do not make monthly payments on that mortgage at all. Eventually, you have to pay this money back. There are 3 reasons that are triggering events that would require you to pay this off. What are they? Number 1, you sell the home. Obviously, if you sell the home, all liens have to be paid off. This is a lien on the house. Option number 2 is if you pay the house off in 30 years, or even if you pay it off early, it does become due and payable at that time. You'd have to pay it off or refinance or something to pay it off. Option number 3, you refinance. Hey, a couple of years up the road, you have some equity in the house and you decide, hey, I want to lower the rate, or I want to take some cash out, or whatever triggering event requires you to do a refinance. What happens is it will become due and payable then. If you have enough equity, you could just roll it into the payment. I'm doing that for somebody right now. It's really simple. Okay, so now we have closing costs. Closing costs are required on all loans. People don't understand, but there are 25 to 30 people that work on every single loan. We have escrow, and we have title, and we have processors, and we have underwriters, and we have assistants, and we have appraisers, and there are so many people that get involved in every transaction. Well, those people don't work for free, just like you or I don't. So we have to come up with the fees. Now, on your average loan, you're looking at, on $300,000 loan, you're probably looking at about $8,000. This loan is more expensive as far as points, because without charging points on this particular loan, there's no way the company would get paid. Everybody would lose money. Nobody would smile, except, of course, you. Unfortunately, we can't do that. So we have a third mortgage. It's called a ZIP program. Now, CalHFA offers this ZIP program, and what happens is they offer a ZIP plus 2 or a ZIP plus 3. Now, a ZIP plus 2 gives you 2%, which is enough to pay the points on the loan, but we still have the other $8,000. ZIP plus 3 offers the 2% for the points and 1% for the closing costs, but we're still short about $5,000 roughly on a $300,000 purchase. Now, where is that money going to come from? Well, that's always negotiable. Number 1, you as a consumer, maybe you have the money. Maybe you have it in a 401k. Maybe grandma can gift it to you. Maybe your cousin Charlie, borrowed money 10 years ago and he's ready to pay you back. Or the realtor that we work with, maybe they can go back to the seller and ask the seller to pay $5,000 or $8,000 in closing costs. This is very, very common. Now, it is more difficult in today's market. Today's real estate market is very aggressive. There's a lot of great things happening, but for every house in that $300,000 market, there are probably going to be 5 to 10 offers. So all the sellers, they just want the most money, just like if you were selling your house. Sometimes they're willing to pay closing costs. Sometimes they're saying, hey, I'm not paying closing costs. I want to maximize what I get. It's all a negotiation. It takes time, and that's one of the reasons a super professional realtor who knows what they're doing with great experience can help you buy that house. Now, we're talking zero money down. You are talking about paying for an appraisal, which sometimes, if we have enough closing cost money, can even be reimbursed to you, but all of these things have to get paid. That is a third mortgage, that ZIP plus 2 or ZIP plus 3. It is also a silent mortgage. You don't make the payment until you sell the house, refinance the house, or pay the house off, the same as the Silent Second. So it's a great program for those people who don't have any money. Now, how do you qualify for the Cal HAFA program? Well, first of all, you must have a 660 FICO score. It used to be 640, but recently Cal HAFA, that's a government agency program, Cal HAFA basically raised it to 660. So if you don't have a 660 FICO score, hey, you can reach out to us. A lot of times there are things we can do. There's tricks to the trade. I've been doing this 29 years. We know what to do to raise your score, and sometimes it takes a month and sometimes it takes 6 months. All depends on what's there. So don't let that get in the way. We'll work on it till we get you there. Also, number 2, there is a maximum income to qualify for Cal HAFA. That in San Bernardino and Riverside County is $138,700 a year. So if husband and wife are both on the loan, well, their income cannot be above that amount. And the third thing you need to do is you must take a first-time homebuyer class. You must, number 1, prove that you're a first-time home buyer. And that really means you haven't owned a home in the last 3 years. If you owned a home 10 years ago, that's okay. You're still a first-time home buyer if you haven't owned in the last 3 years. And you must take a class. It's a very simple class. You can take it online, but you do learn some wonderful tools and wonderful things to get ahead. So let's recap a little bit. Number 1, the great things. No money down. We can also cover some of the closing costs. That's a great thing. That's the good. Now then there's the bad. The bad is the interest rate could be a little higher or will be a little higher than a standard program. So if somebody says to me, hey Chris, I have the down payment, or grandma's going to gift it to me, or I can take it out of the 401k, I encourage you to do it that way. Why? 1, you're going to get a lower interest rate. 2, you're not borrowing the money. You're just paying it and it's done. 3, the qualifications are different. As an example, on a standard FHA loan, for most people, we can go up to a 57% debt ratio. That means take the house payment, add the car payment, add the credit card monthly payments, the minimums. I'm sure you pay extra, just the minimum payment, which helps you qualify. Any student loans, any installment debts, child support, alimony, let's add them all together. On a standard FHA, we have to make sure that's not over 57% to get the approval. On a Cal HAFA loan, you are limited to a 45% debt ratio. So you have to be in a little bit better financial shape because remember, you're putting no money down, no skin in the game. Now, there's always people who reach out to me when I make these videos who say,
people shouldn't buy homes if they don't have 20% down.
Well, you know what? That's nice for you, but it's not nice for the little guy who wants to buy a house. Let me teach you a couple of things about buying a home. Do you know if your children, the children of homeowners, score higher in school in math and in English than children of renters? I don't know why. This is done, you can Google this, it's a study. It was also proven that they are 50% more likely to graduate from high school and 130% more likely to graduate from college. The reason we buy houses is not just financial, but we want to give our kids every opportunity and every advantage. That's another reason to buy a home. Look, these programs are there for you. You can have a $138,000 income, which is a lot of money. And you can still buy a house with no money down. If you have the money, I'm still going to recommend you put the down payment. Okay, so my attitude is you have everything you need. As long as you have reasonable credit, you have the income, you don't even have to have the down payment. What are you still renting for? Don't you realize that rent goes up every year? But the house payment stays the same. And people say, but Chris, it's higher. Well, yeah, sometimes it's higher initially, but let me ask you a question. Are you going to get a raise next year? Maybe you're going to get $1 an hour raise. Maybe your wife's going to get $1 an hour raise. A year from now, do you realize that a year from now you'll be making an extra $346 a month? So sometimes we have to suck it up for a little bit of time. When I was a little kid, I remember my dad saying, $272 a month, how am I going to make these house payments? You know, he only made $7,000 a year in 1969. But what happens is over time, you get a little raise, you get a little raise, you get a little raise. I bet you if you stopped eating out, Look at your bank statement. Go through all the ATM charges for eating out. Eating at a restaurant, eating at McDonald's, eating at Applebee's. Go through and say, how many times did I go to Starbucks? Leave your ATM card at home. Every time you walk into a store, say, do I want my own house or do I want those shoes? Do I want my own house or do I want that book? If you start to think like that, you are going to become a homeowner. Together we can do it. We are going to fire your landlord. To start the process of firing your landlord, go to fireyourlandlord.info, click on the Apply Now button, fill out an application, takes 5 minutes, and together, we're going to fire your landlord.